Hey everybody, we are live. This is Lane and Jane here. We're going to be doing the 42nd edition of this thing of August 2021. Here's the intro.
In Hawaii, there's so much to do. There's hula, there's surfing, and real estate too. We're just two local guys with so much to say. So listen to the Real Estate Braddahs today.
Here we are again. All right, let's get going through this. If you guys want to go get vaccinated, get the free remote investing e-course. Just send me an email, lane@simplepassivecashflow.com with the subject line F-COVID, which stands for the F variant, which will probably come out here soon. But yeah, Dean, take us away with your portion of the show.
Sounds good, Lane. Yep, episode 42. We're jumping into August. Wanted to start off, as always, talking about the real estate statistics. So we're talking about July 2021 real estate statistics, and the information will come out tomorrow from the Honolulu Board of Realtors, but I believe it's gonna be record breaking again, and it's almost like a broken record. I think what we're gonna see here is, again, this is not, might be off by 1,000 or two, but I think we're gonna, on the single family side, we're gonna have another record breaking month with the median price around $989,000 compared to the previous record, which was last month at $979. And this is compared to prior year, July 2020, of $815,000. On the condo townhouse side, we may finally be breaking that record again. I think coming in at $470,000 is what we're thinking in terms of median price for condo townhouses. The previous record was $461,500 in July 2019, and this is compared to $440,000 in this should be July of last year. So we just touch real briefly. I know we go through this every month, so real quick. So new listing trends. If you look at this report, it doesn't seem to look like much when you kind of look at you see the seasonality, and it's the dips when it gets into the winter time, and then if you take a little deeper look at this, you also see a dip again right in the March-April COVID 2020 period. So we also see that. But when you look at the next slide, I think that's the one that's kind of indicative of why we're in what we're in, month supply of inventory. So as you can see, at the beginning of 2020, inventory started to bump up, especially for condos and townhouses, the gray line. And then, it just went downhill from there in terms of month supply of inventory. And now you see the condos inventory is also going down, real similar to the single family. Not there yet, but that kind of makes me get into, segues into the next discussion. So this here is Paul Brubaker. So he did a few presentations to the Honolulu Board of Realtors, to the full board, and also to the Leeward Regional Group. And so I just wanted to share the slides. I really geek out over him. He's one of the chief economists and touted economists in Hawaii. A lot of banks used to hire him or employ him. Now he's a consultant, but he did these two presentations this month, and the topic was, are we in a bubble, real estate bubble? So so the majority of my section today is just a bunch of his slides and trying to summarize what he said. We talked about him before because I kind of geek out over him as a finance major. He was economics, but very related. So basically he's saying that for a lot of this quote unquote bubble, or if it is a bubble, it was because of the work from home situation, right? And we're seeing it, if it is truly a bubble, he thinks it's more on the single family, of course, and not so much the condos. I started off with this slide, but I wanted to get into more of the his charts, right? So this chart here is showing new listings from 2016, 2017, and so the dotted line being condos, townhouses, and the blue solid line being single family. So we see down in March, April 2020, the big in that gray area is where the beginning of COVID, where there wasn't any new listings popping up. It just is a big drop, right? And then as time went on, we can see that, especially the dotted line for the condos, those that inventory started coming on market a lot more than the single family, excluding, you see, the November, December. But we had that big hiccup in terms of inventory not coming on market for those 3 to 4 months. Yeah. So that was kind of like the beginning of the story of how, we're kind of where we're at now. So this next slide is kind of cool because we talk about, are we in a bubble or not? So these are just for single family median prices on Oahu, but you can see what they try to do is chart off the macroeconomic bubbles that occurred, right? So we have the Japan bubble in the early 90s, and you see prior to that, we see the median prices climbing, steep ramp up, and then after the bubble, now then it's a downturn, and it's kind of, it plateaued and it starts to go down, but not too bad. I mean, it did affect us pretty major, but it doesn't really show in this graph as much. Then we see the next one, we have the subprime crisis, right? And again, we see it ramping up. Yep, we see it ramping up there, and then it plateaus, and it doesn't take as much as a dip or as long as of a dip as it did as the Japan bubble, because the Japan bubble affected Hawaii a lot stronger than the subprime market. So now we're up to 2020, right? And we see that last gray that line, and the question then is, are we in that bubble? But we don't really see a big climb, right? So that dotted line going across is kind of like the best fit line, 4.66, like appreciation kind of thing. And so we don't see it like ramping up like how we did for the Japan bubble or the subprime bubble. So that's a good sign from the standpoint of it seems like we're not yet in a quote unquote bubble per se. So that's, to me, how I read that slide. Next slide is kind of interesting. He referred to what's going on now in Hawaii as the donut effect. And so here we have Oahu single family home price appreciation for 2020, and this is by neighborhood. So the donut effect meaning the urban core of Honolulu being the middle of the donut, and everyone moving outwards towards the North Shore, towards Anaheina, Kailua, Moanalua, Mililani. So we see on this chart the appreciation for those areas, right? And the interest in how it's ramping up so much, versus when you look at what at the bottom of the chart, what didn't do so well, and went in fact in the other direction in terms of losing value of downtown, Diamond Head, Ala Moana, Kaka'ako. So furthermore, on the next slide, we talk about Oahu condominium prices. So same story, right? 2020, we see the suburbs ramping up in terms of appreciation. Waipahu, North Shore, Mililani, Makakilo, Pro City, and then we got that middle of the donut with downtown, Kapuhulu, Kahala. So again, showing us how people during COVID are kind of moving outward, And we talked about that too. Lane, from the standpoint of, when you're downtown and, in the and it's ramping up now again. But before, when it first hit, it's like, okay, well, you have to social distance in the elevator, so people trying to get to the penthouse in their Kaka'ako home are waiting like 4 elevator rides because they can't fit in the elevator and social distance properly. So that was part of the reason, right? And another reason was a lot of people were being able to work from home. But again, I'm getting ahead of myself. So the next slide again. So now this is 2021 appreciation for condominiums, and again, kind of similar story. We have the highest jumps with North Shore, Eva, Waipahu all on the west side, Wailai on the east. Then we have Pro City and Mililani, and then on the bottom Ala Moana Kakako. The Aina Kulio that that might be just an outlier because I don't think there are too many condos out that side. Yeah, so I just chalked that up to being an outlier from my stem for the purposes of this. But the next slide, is talking about how with COVID, and we talked about this too, is like with COVID, before, even with my old employer, working from home pre-COVID was very stigmatized and frowned upon by my boss's boss, in fact. And so we weren't really allowed to work from home, even though we had VPN and stuff like that. But nowadays, you're looking at nationwide how companies are reevaluating their work from home policies, right? So 35% are looking at all employees and giving them an opportunity to work from home. So some of them 30%, or most employees, and some being 20%. So it's a big shift, especially I think for the big employers. And I mean, this is like IT companies aside, right? I was working for a large utility, kind of a dinosaur. So a lot of our stuff.
You're just a man before your time.
Yeah. So
they never trusted you with that solitaire on your computer.
It was mahjong actually.
Yeah.
But so, but on the next slide, what the Economist talked about next was about how productivity actually increased during COVID, and there's a big jump in our productivity. And I think that's a funny thing because the whole stigma from my understanding is from us, they didn't want the employees to work from home is because there's too much distraction. We would be inefficient and not as productive. However, according to this Fred data from COVID, we became more productive in terms of the employees' productivity. And
here's how they measure this, right? What is this, like TPS per week or something? TPS report? Like what do they measure? Like
that's a good point.
Mouse clicks per second? I don't know.
I mean, to me, it makes sense too, though, from the standpoint of the mindset shift, where it's like, well, people are gonna still get their job done, right? And with the COVID, you had conflicting priorities. If it was kids homeschooling and things like that, so you had to get that done. You had to become the teacher, the TA, the IT support for school, and then you also had to get your work done, right? So I think it did make people more efficient. And then something else too on the next slide, it talks about because of the there was actually productivity because of the fact that there was more company dollars spent on IT processing equipment and software by companies, and that will it'll make you more efficient, even from the standpoint of when you're trying to do work, your computer boots up quicker. You don't have your laptop doesn't have problems with Adobe because you're trying to print, because now you have a newer processor and you don't have these issues, and you have drivers that work. So this large spend on IT equipment and software probably assisted in helping employees productivity go up just by giving them the proper tools to use. So I mean, that's kind of interesting too. So what else did Mr. Brubaker talk about? So now on this slide, he's kind of talking about so is it a bubble? And in the middle, we're talking about fundamentals. He's saying, based on the fundamentals, it doesn't seem to be because, we have the low interest rates, we have the recoveries, strong balance sheets. So it's not like the previous quote unquote bubbles. The COVID effect is creating the donut effect, and we he did mention, some quote unquote bubbleliciousness is what he deemed it in certain areas for single family in terms of Kauai, Maui, on Oahu, which um, he considered like Zoom town because people could flock there and work from there. So I thought that was a kind of interesting comment when he said Zoom towns. But when the next slide, he starts getting into our, I guess, our main economy, which hotels. So the point of this slide is saying that our lodging capacity on the neighbor islands haven't grown since 1992, but where they see capacity increasing was in the realm of vacation rentals. So that's the purple, right? So, but the funny thing is, how did these vacation rentals start increasing? And part of the reason is because we're having Airbnbs popping up, right? And the ones from homes, it wasn't from capacity from the hotels. So to segue into the takeaways, though, laying on the next slide, I guess he was saying that on Oahu, prior to COVID, and I didn't realize this, but Lane, did you know that according to Brubaker, he said people have been actually, there's been like a exodus from Hawaii, and in the last 3 years, there's been people actually moving out, and I think that's contrary to some of the articles we see about people from California moving here and things like that. But prior to COVID, it's been an exodus out, and a net negative in terms of our population is what he was saying. He's saying that there are inflationary periods ahead, and with that said, investments tend to move to real assets, right, like real estate. So what he sees is going to see, we're going to see an increase in interest rates, but not like how we did in the past, because now the feds know how to manage the they use the interest rates as a way to manage inflation. Yeah, so we're not going to see super huge spikes, is what the predictions are. And also, with that said, back to the whole question about vacation rentals, and in 2020 we had the banning of vacation rentals and the Airbnbs going. But Lane, on the next slide, you see in reality, these vacation rentals were illegal since 1989. But according to these laws now, they're in 2020, they're trying to enforce it now. And the challenge is that enforcement is by whom? It's by your neighbors calling in and saying, hey, somebody's running an illegal short-term rental, So it's kind of weird from that standpoint. And the contrarian thing with this is that how we said earlier in that other slide is that the growth in the lodging and inventory was from these quote unquote illegal vacation rentals. So he doesn't think that they're going to go away. And the other problem too with which is why I think he's saying it's not really a bubble per se, is that we don't have construction keeping up with the demand for housing. So 40 years ago, we had, annually we had 13,000 permits to build new homes in Hawaii. So now in current year in 2020, we had 1,200 permits. So, I mean, it's not keeping up with the demand in theory, right? So, not necessarily demand, but we're not building a lot to create that bubble, because we have the demand, but not the supply to overtake it, I think was one of the biggest takeaways. So what I feel, to, I guess, sum it up, I feel like this economist is saying that we're not, in theory, we're not like in this huge bubble that people might be thinking we're in. So I don't know. That I thought it was interesting, maybe little geeky, but I thought, we talk about this all the time, Lane, and I don't have any. It's all anecdotal, right? And so now we have something to back it up. Whether it's true or not, who knows? But I just fun to talk about.
Yeah, yeah, and you
And
went
the,
ham on Bootbreaker. For a reason.
I do like that guy. Like since college, we used to go to all the D-bed presentations and the conferences, and they had big panel discussion with him, and the other big economist was Leroy Laney. I think he was with FH. They were both with FHB and Banco, the biggest bank. So they were hired, to help forecast their banking sales so that they can plan. So I geeked out over that.
I'm,
So
I don't know. I'm not a huge fan of economists. They're kind of like the weatherman. They make predictions. They're half the time, and then whenever you hold their feet to the fire, like they're just making guess. And
that's for all forecasters, right? I mean, like you said,
Yeah.
whether even like budgeting and forecasting for sales like that, we have to have a method to the madness, and we have to have something. But is there a look back period to prove anybody wrong? Typically, no.
Yeah, yeah. I don't know. I was watching like the gymnastics thing, and this guy was just going like super detailed on like the scores. The gymnastics could and could not get. And I was like, dude, man, like they just got to play the game. They just got to like get out there. This guy is getting like geeking out at like the ranges of scores that somebody could get and who can place where.
Like level, like if they don't do this high level of difficulty, then they won't be able to maximize all that kind of stuff.
Yeah, and I don't know. It kind of reminded me of like, economists, right? Like I want to see an economist actually put up some money and actually put some skin in the game and invest, right? One way or another, right? If he believes that there's not in a bubble, well, let's go. Let's pony up. Let's put up some money, buy something, right? Or the opposite.
Yeah, that's true.
But,
Hey, we have a question from JD Hoovener, and I might need your assistance. So it says, as a mainlander, so what are the three main differences between real estate market between Hawaii and say Seattle? So did you want to try that, or should I?
I'll
I know you used to live in in
I'll take a
Seattle.
stab at it first, but like to me, I think this Boot Breaker makes it seem like Hawaii is a special market. Right now, it's nothing special. I mean, across the nation, everybody is hot because people aren't. There's uncertainty for sellers, so they're not putting their houses in the market. Therefore, supply is low. I don't know what demand is, but right now supply is beating demand. Therefore, prices are high. Seattle, Seattle is like it's a different play because people are moving there for the Amazon, the tech. It's a great place to live, in my opinion. But that's why it's super expensive. But it's the mainland's a little bit different than Hawaii. Hawaii is you don't have new places built. It's a lot smaller market. But both of them are primary markets, which meaning you're not going to have the rental value ratios to be able to like cash flow out here. And part of that is because Hawaii and Seattle are probably in the top 10% of places people would want to live. And that's, in my opinion, why I don't want to invest here.
Right. Yeah, to your point, yeah, I think you hit the nail on the head from the standpoint of like if you take Hawaii or Oahu, we're on an island and we have a limited amount of space that we can build on. So it's kind of like if I'm not familiar with Seattle so much, but you can I'm assuming you just move further out away from the metro area if you want to, and they're still having new construction and that they're building stuff out there. Like Hawaii, there's a lot of red tape when it comes to construction, JD, especially we have one of our biggest master plan communities, Core Ridge, about 3,500 doors that from the point in time that they purchased the land to build it took over 20 years for them to start building homes because of the quote unquote red tape, whether it be environmental or governmental. But is one of the big factors in terms of having, slowing down our construction. Besides the fact that there's no place to build, right? So, I mean, that I think that's one of the bigger things, right, Lane? And I mean, I think another thing too is in Hawaii, we don't. Our main industry here is tourism, right? And then our second one is the military. I think Seattle, it's a little bit more diverse, right? And then you have in the outskirts, you also have other areas that you got Kirkland, right? With the Costco's, and you have the Bellevue at what is that, Amazon Lane? What is that?
Here in Seattle, you have your Seattles, your Kirkland, your Bellevues. That's where everybody wants to live. That's the east side in Hawaii, right? That's where you have your old money, your Manoas, your Honolulu, your Hawaii Kai. But then people move out when they can't afford to live in Seattle. They move out to like Auburn, Renton, or like in California. You can't live in LA, so where you go live? Rancho Cucamonga, way out there. And you commute, but that's in Hawaii. The equivalent is going out to the west side, to Kapolei, Ella Villages. I mean,
Yeah.
That's far out there.
But
it's all the same, right? There's places people want to live, and there's places people have to live because they can't afford it, and they got to pony up and drive.
We have another comment. If you want to take it now, you want to continue, Lane?
We can take it now. I mean, maybe you can speak to the eviction moratorium in Hawaii.
Yeah. So, I know news just came out today about that, because we were supposed to, the moratorium was supposed to end tomorrow, I believe. And I know, we do talk about the moratorium. I thought we talked about the news in terms of
we talk about this every month, but it's like the same freaking story every time. They keep extending it, and it's like after a while, I don't talk about it very much, because this is exactly why I invest in red states. It doesn't really matter if you invest in the right places, but in Hawaii, I mean, I think it's a little bit more impactful in Hawaii. I don't invest in Hawaii, so I don't know.
Well, another thing too is, I think, I leverage out my property management to property managers. So, in fact, I just did a series of videos for my YouTube channel where I interviewed one of my local property managers to talk about the moratorium. So, but it's supposed to end tomorrow. And my apologies, Tony. There was news that popped up. I don't know if you're talking about nationwide or in Hawaii, but I know before we jumped on this Zoom, I know there was something with the governor and the moratorium. I don't know. I'm not too sure if he extended it or whatnot. So my apologies. We can get back to you on that.
Yeah, well, they kicked it forward. It was going to expire this month. I probably said that 5 months again. But
then I know Biden Biden extended it, right?
Yeah.
And my understanding is when he did that one a few days ago, it was like affecting it like 80% of the country or something. So, but anyway, we got a whole bunch of questions popping up too.
Yeah, that's good. This is supposed to be an interactive type of platform, folks. So if you guys have any comments or questions, please put it in there. What red states are you investing in? Well, Texas, Arizona, Alabama, Georgia, Oklahoma, a little bit in Florida, I guess, too. But yeah, that's where the population is going up, in my opinion. So,
this is 1031 question from Matt. How hard would it be from a timing perspective to sell 3 single-family homes in Cleveland and then roll the proceeds into one of Lane's multifamily deals?
We will talk offline off that, Matt. That seems like a personal situation.
Matt, contact Lane.
Yeah. Actually, anybody who's got a 1031, I don't recommend ever doing a 1031 exchange unless you're looking to exchange more than $500 to $1 million of capital gains.
To make it worth it.
Yeah, it's just not going to happen, and then you're going to be stuck in the same predicament in 3 to 5 years of future already.
So I want to end my section with. Oh, go ahead. Matt's gonna ask some questions, and hopefully, regardless of the kids go to bed,
you
gotta
guys
keep.
on the mainland asking these questions. This is the Hawaii show. You guys got the wrong show.
No, we touch on both. But Matt, regardless, you still gotta keep your questions clean, even though the kids went to bed. I don't know if that's where you're going with that one.
Yeah.
But anyway, my second, I want to end with the buyer's corner. So I always like to talk about practical matters. So one of my team members had her offer accepted on a single family home on the neighbor island, and it was a multiple offer situation, and the buyer submitted a very compelling cover letter, and they ended up winning. And I believe
you actually read those things, man. The sob stories.
And you know what? According to the seller's agent, it actually made the seller tear up because of how well it was written. Yeah, I mean, I don't know if Mr. Jordan was the one selling it, but yeah, according to the seller's agent, it made them tear up because it made them think of how they were when they bought that property. So their point being is that there's sometimes that taking the time to draft a very thoughtful and emotional cover letter works. On the other side, though, you got to think about the letter could work against you in terms of somebody could read it and it could go the opposite way and not like it. Another thing to consider is that some brokerages and jurisdictions are actually talking about not accepting cover letters for the real estate transaction process because of potential legal implications in terms of the Fair Housing Act. I believe what's happening is potential buyers have made complaints that they may have been unfairly ruled against because of their letters and being a protected class. So I think with those potential things on the horizon, there's now talks about just not even submitting cover letters, and it could be a decision by the brokerage because of their risk management / legal team, or it could be something that the entire industry does in terms of the Honolulu Board of Realtors or the Hawaii Realtors Association.
That's what I'm talking about. As a buyer or as a seller, I wouldn't even open that thing. I wouldn't even trigger that read receipt, so I don't trigger any of that stuff.
Yeah, I mean, as
don't ask, or don't hear, don't listen, don't hear. I don't know.
And as investors, Lane, I mean, especially on when we're trying to decide to sell these homes that either we used to live in or we held for a while or we inherited. A lot of times we need to remember to take emotion out of it, right? From the standpoint of, what kind of return are we getting?
Sued, right? In this case, I don't want to open up a letter and they just say I'm this race or I got this disability, and now if I don't give the deal to them, that they're gonna sue me.
Yeah. So yeah, from your standpoint, yeah, Lane, I totally get it, and however, like I said in my example, we just got a deal because of it. So yeah, it's a judgment call for now. It's a judgment call for everyone, but yeah, do you play that warm and fuzzy game or do you risk having issues? So just my buyer's corner point of discussion I wanted to end my section with.
That one that's a new one. Don't even leave your house, right? You're gonna get sued. All right, well, hey folks, if you guys want to get the remote rental e-course, shoot me an email, lane@simplepassivecashflow.com. Even if you aren't vaccinated, that's cool too. You just put light in the subject line, we'll give it to you for free. So this is my portion of show. We're going to talk a little bit more about more mainland type of investing stats. But the first thing here is a little bit of a teaching point. So I think I've been talking about to you earlier, Dean, but there's some people that like send over like deals, like private money lending deals, right? Um, and they'll be like, "Oh, hey, lend money to this deal. These guys are flipping a house, and they'll give you 15, 18% return on your money, right? Per pay per year." And that's a really good rate, right? So most unsophisticated investors will take it. But when you start to dig into who's the actual operator, who's the house flipper, they're just some Joe Schmo that this is their first, second deal they're flipping. So it's substantial extreme risk, right? So you're buying this crappy B3, B minus B paper, right? If you were to kind of line it up with some kind of normal ranking system.
Yep.
So what some people will do is they'll build up a brand and they will white label those crappy loans and sell it to. They'll go to Dean and be like, "Hey, Dean, I've got this the same note. You want to lend on it, and we'll give you 12%, right?" But little do you know is that I'm going to that newbie flipper, charging him 20% because nobody wants to lend him money, but I'm kind of just white labeling his loan to an investor like you. So this happens a lot. I mean, this is hard money lending.
Yep, I've heard it too. And then a lot of times you have no recourse. You're not even a priority on no collateral, no means if there's a default, right? And that's why you're getting these high rates, right?
Yeah.
Risk versus return.
The folks who have done dozens and dozens of house flips in the past that have a good track record, they can borrow money all day at like 5 to 6% or less. And those maybe you consider that more like A paper, B plus paper. But I just wanted to say this because like investors will shoot me an email saying, "Oh, this guy's he wants to pay me like 15, 18%." I'm like, "Yeah, because it's garbage paper is what you're buying."
Junk bonds.
Yes, yeah, exactly, like junk bonds or subprime lenders.
Yep.
And people just don't understand this. So I had my VA make this chart for me so I can explain it to everybody.
I like it.
So I like athletes because they pay all our taxes for us. Those poor guys get hammered compared to like the wealthy people who actually know how to pay their taxes. This kind of slide shows this. But it's tax time. I got to do my taxes again. They're due October 15th for those of you guys who extend every year. I am licking my chops. I'm very optimistic once again that I'm top ahead. If you guys want to see my old tax returns, go to simplepassivecashflow.com/tax. You might be pretty upset. And the internet has all kinds of people out there, right? I mean, there's a lot of like micro influencers, especially in the crypto world. Just be careful out there. Everybody seems like they are a magical crypto trader, but this is kind of why I stay with real assets, no tricks, no games. So this first graphic shows the tax rates of different countries. Here, the U.S. down there on the bottom left is at 24.5% average rate. It is a lot lower than all these other countries, like in Europe and
those socialistic countries.
Right. So someone said in our Facebook group that a lot of these countries have government provided healthcare, which makes sense for the added 10%, 15% costs, and that makes sense. I mean, I'm probably I'd gamble that the United States will probably have some sort of, I guess that's what Obamacare was all about.
The universal, yeah.
Yeah, we'll probably head in that direction at some point. Taxes will be going up.
Like Sweden, right? Because I have a few friends from Sweden, and like you said, the rates are ridiculous, but they have healthcare for all, right?
Yeah, I'm trying to look for Canada, but oh, there it is, the little maple leaf, 33.5%. I know they have government. All right, so this is from Apartment List, national rent growth exceeding pre-pandemic trends. So just like your other slide of the prices of homes going up, the prices of rents tradition go up very um, cyclically in a pattern, and it generally follows an upward trend until the pandemic happens and things kind of slowed down, paused a little bit. But now, as of beginning of 2021, rents are off to the races, and we're going to see some of that data here in the coming slides. National index up 9.4% since March of 2020. So rents are going up.
So, and maybe this is for to take offline, but how does it affect when you folks are underwriting deals in terms of the rent increases? Are you following this trend of the big ramp, or are you kind of toning it down in terms of more that dotted line?
Whether in the pandemic, pre-pandemic, or now post-pandemic, we always use the same number, which is like usually about 2% rent increases per year, just to keep up with the pace of inflation. If you're seeing people out there underwriting for 3, 4, 5, 6%, that is crazy. That's not going to happen. They'll chuck that deal out into the water.
And that would be the quote unquote loss to lease portion of the value add play.
Well, it's just like it's just not going to happen.
Mm,
You know, like
that's
I
gravy.
think,
That's all gravy. That's all
yeah,
gravy.
if it happens, it's great. But I mean, I think you want to underwrite for the normal, what you think will normally happen. Maybe not what's happening right now because there's great growth, but what's normally going to happen. And here's the thing. Like I was thinking this when you were talking about the economists, right? So these big companies hire economists to give them these takeaways and ultimately give them a number, right? And you are a finance guy. You're just waiting for that one escalator number that the whole company was going to use to drive up
right.
annual escalator on capital purchases, etc.
Yep. Exactly.
It's never. It's always, well, just give me the damn number, right? We're gonna do what we're gonna do. We just need to know what it costs.
Right.
It's not
Right.
it's not to make a binary, yes, we will purchase these things, no, we will not. But that's what sophisticated businesses do. But what the layman does, the average person, is asking the economy, or they're looking what the economist is doing or watching the news, and they're making a binary: do I buy a house to live in now, or do I wait? Which to me is a stark contrast from what businesses do. I think
Mm.
people need to act more like businesses. Are you going to buy a house to
Businesses,
live in?
you can't wait. You can't wait. That's why as a business, right?
Right, it's going to
That's not
keep
an
going.
option.
Yeah, it's going to go up,
Yeah.
but you just need to know how much it costs to account for it. But people have it backwards in their own personal finances, where they're letting the stuff dictate what they do, or fear dictate what they
Right.
do, or euphoria dictate what they're doing, I guess. But I don't know. It's just I think if you're going to go buy a house, go buy a house.
Yeah. It's like the stock market bears 5 years ago, 8 years ago, right? They're trying to time things, and it's like, and look how much you lost out. Not that we like to talk about stocks on this, but I
Yeah.
mean, prime example, because we do see that too on the real estate, either investing or even trying to buy a home too. It's like, oh, I'm trying to time it. Should I wait? What always looking for the answers, and everyone has to do what's right for them, right? And to your point, Lane, it's like especially for when you own a home, it's hard to time owner occupant home. I mean,
Yeah.
you can, because I know philosophically, Lane, I know you don't even want to own your home because you don't want to have that lazy equity. So you're from that standpoint, if you're having your equity work from you the way you do, then you're trying to constantly deploy the equity because you want it, because what you're putting it into is cash flowing stuff, right? So that's a different play than others who are just like kind of sitting on the side and waiting, right?
Right. So I mean, the recap is amateurs let this stuff, play into their decision, yes or no. But the pros, they do what they're gonna do, but they let it they just let it change the budgets getting there,
Yeah.
I guess.
Or are you looking for different alternatives in terms of opportunities, right?
Right. So this next slide is from John Burns, The Rise of Sister Cities. So all this is kind of talking about is you got places like Seattle and Tacoma, Cleveland and Canton, Ohio, New York and Philadelphia, Durham and Greensboro, Palm Beach and Port St. Lucie, Dallas Fort Worth, Denver and Colorado Springs, Los Angeles and Bakersfield, East Bay and Stockton, and Phoenix and Tucson. So the big city is the first. The second is the sister city, and I guess it's what it's saying is don't discount the small sister city along with it. And this kind of goes along with, I think the book is Big Shifts Ahead. I think the rise of larger metropolises where these big cities just kind of clump into one big MSA. This one is from Real Page. This is talking about second quarter apartment demand, net increase in occupied units. So from the top, Dallas Fort Worth, Los Angeles, Orange County, Houston, Chicago, South Florida, Washington, D.C., Bay Area, New York, Seattle, Atlanta, Phoenix, Austin. So,
I'm surprised Chicago's on there.
yeah. So like New York, Chicago, Seattle, they had a little bit of a bounce back, right? Because if you recall this time last year, these places were kind of ghost towns, but you're having the bounce back right now. Yeah, to me, it's kind of like living in Hawaii High. That's where you want to live, in my opinion. Might get too expensive, but people keep going back to the urban areas.
Because if you're the haves, then why not, right? I mean, it's a safe haven.
Yeah. I mean, it's low cap rates area. I mean, low cap rates are bad for investors, but the reason why it's a low cap rate is because it's a low risk area. It's always going to be the best place to live that people want to. You don't have to worry about New York, going downhill. It's freaking New York. Leading indicator of remodeling activity, the second quarter of 2021 is going up. And this is the trend that has been going on since the beginning of the pandemic, where people have been kind of remodeling more. This from Adam. This is a little surprising. U.S. foreclosures in the first 6 months of 2021 hit an all-time low of 65,000. I guess that makes sense, right? Because
I think so.
No foreclosures.
Well, I think unlike the subprime crash, I think a lot of people still are in the black in terms of having equity in their properties, right? Because the debt ratios weren't in terms of the financing, people weren't allowed to do 100% financing or something ridiculous. So people still have equity. So those that need to get out can get out and not have a distressed property situation, I think.
Again, from the Joint Center of Housing Studies for Harvard University, this is no different than the slide that you showed earlier about inventory going down in Hawaii, but this is nationally. Fell to another record low in early 2021. This is what makes the prices go up. So now we're overlaying the year-over-year changes in prices on the national scene. And, low supply means supply and demand curve. That means the prices go up. Surpassing the hotness of the market in 2013 and 14, in case people want to know.
Mm.
You don't need an economist to tell me that. And you don't need an economist to tell everybody that rents are rising quickly everywhere. This is just a little map of all pretty much 100 largest U.S. cities, red means rents are going up. Here's a graph of population growth. So you were saying earlier that here population growth went up 1.5 million or 7%.
Oh, interesting.
But here's my take on it. I mean, I agree with you. People are generally moving out that can't afford to live in Hawaii. The people moving and replacing it are more of the affluent people that can remote work and retiring. So
And,
I'm sure
and afford the houses here.
exactly.
Right?
Exactly. So it makes sense that the new houses supply, like a Core Ridge, is above the median or average because the low end is being replaced by the high end,
Yep.
and overall the population is going up. So across the nation, I mean, population is going up too due to immigration. But places that are going up double digits, Washington, Idaho, Oregon, Nevada, Colorado, Arizona,
Utah,
Texas, Florida, Georgia, South Carolina, North Carolina. The Northeast is just pretty much a little flat line up there.
Yeah. I'm surprised like Illinois is at a status quo and not like a negative.
Yeah, well, that to me that's pretty much a negative, right? If you're at
Yeah.
0%.
Yeah.
I mean,
Also, this is over a 10-year period, right? It would be interesting to see if it was like a shorter window, like a 3 to 5 year. Then we'd see a lot. Probably we might see a little bit more disparity, or some reds in there and some brighter blues, right? In those areas that you mentioned, the red states too.
yeah. Do you still own that Chicago stuff?
I am in the process of selling it.
Yeah. Don't do a 1031 exchange.
I am
Friends,
not
don't
gonna
let
do it
friends
today.
do a 1031.
You know what? Honestly, and we discussed this too. We agree to disagree. Right? I think there are times where 1031s do make sense, and I mean, if we're consistently doing, say, syndications, and then the 1031s offer a level of stability in terms of not having to do a lot of short term tax planning, I guess is I guess how I'll deem it, right? Because like how we're talking about creating like a syndication ladder, then you're going to consistently look for the new deal to shelter the gains from the payout from your syndication that's cashing out this year. So I do see a time and place where you could use it to park some deferred gains indefinitely, and then also use that property as a legacy. I guess property, and especially assuming the step up basis law stays the same. It's a great way for you to pass on legacy wealth, right?
Yeah.
And then have that deferral be permanent, or at least when you pass it on to your heirs. So I do see merit in the 1031 from that standpoint.
Yeah.
But I do understand where you're coming from, Lane, and I do agree for in certain cases.
Yeah, and those cases, I mean, I do recognize that, but they're pretty rare. I mean, the two cases where I would use it is if you're talking about a huge exchange, like you're sitting on at least maybe $1 million plus of capital gain depreciation recapture. I mean, that's a big whack. We got to sit down. We got to talk about this. Come up with a plan. We may need to do a 1031 to just delay the inevitable.
Right.
I mean, I just asked this recently, and thankfully my clients know I'm not being a jerk about it. But I'm like, well, how old are the people? You know, if it's grandma and grandpa's property and they're like 90 years old, well, they probably won't live for another decade or two. So in those cases, it makes sense to do it. A lot of my clients have a really good sense of humor, right? I mean, I've had a couple times where people are like, Lane, I'm gonna die soon. I'm already 80. I don't think I'm just gonna hold it. I know it's a bad idea, but I'm just gonna give it to my kids with a step-up basis.
And
That's when you don't, if you need to do the 1031, you do that
right,
just to
yeah.
get you to the finish line.
I mean, talking about that kind of stuff, I mean, it's legitimate. I mean, it's kind of morbid, but I mean, that's part of tax planning and what the tax planners do for you, right? It's like setting up your trust. It's very morbid talking about you're gonna die, and if and when you do die, what's gonna happen to your assets. So it's depressing at times, but it's practical, and I think it's like doing any business decision. You're looking at all these options, and it's in terms of business, it's risk management basically. Yeah.
Yeah, I mean the system is designed to take money from people who aren't sophisticated, like rich people who just have all their money in one property and just pass it off to their unsophisticated kids or athletes, right? Athletes pay a high tax rate because they just don't know what they're doing in terms of taxes.
Yeah.
I mean, that's why 90% of wealth leaves the family in 2 to 3 generations.
Right. One of my old bosses used to say, the IRS is not gonna hand out you these tax breaks. You have to go out and find them, or hire someone to find them for you. Yeah. So.
Yeah. If not, how will we fix the potholes?
Yeah. But I think knowing that those types of shelters are out there is the beginning, right? And I think that's how your education works, right? Is letting the investors know that there are these alternative investments out there, outside of what we've learned, in terms of 401ks and the stock and bond market and stuff like that. So yeah.
I mean, there's just a lot of people out there that are good little boys and girls, and they do what they're told, and they don't question the man behind the curtain, to use a Wizard of Oz reference, and they think that the best way to shelter taxes is a 401k or a Roth IRA, which I think are really horrible ways to doing like sheltering from taxes.
And we have a great comment from Mr. Sanford again. He said, don't forget about your life insurance policy designed for investment. So I'm assuming he's talking about infinite banking, right? And creating your insurance policy that you can use it. Be your own banker. I don't know. There's so many different terms for that, but I'm thinking that's where Mr. Sanford is going with that one. Yeah. So yeah, that's also another great tool that not everyone knows about and uses. So that's a cool one. And to be honest with you, Lane, I haven't yet, but I'm playing with that idea now.
Yeah, it's a no-brainer. If your net worth is more than $500,000, no brainer.
Yeah. Thank you, Mr. Sanford, for that input.
But yeah, to end things off, if people want to get into a group with more accredited investors, they can check out my family office on a mastermind. Go to simplepassivecashflow.com/journey, and my book is coming out.
I was gonna say, is that a new book? I like the cover. The cover is very attractive.
I didn't tell you about this.
No.
A script for you, but it's right here. I've been reading it and recording it. I just sit here and I read it, just like I'm reading you guys a bedtime story, and then I've been recording it for my audiobook. So at this rate, I will finish it by Christmas time. But it's coming out. But here it is. But I wanted to do the audiobook too at the same time, because who reads books these days?
So the release is going to be for Christmas then, around Christmas time.
I don't know. We'll see. I have to finish reading it, and then I'm recording it too at the same time.
Oh, that's cool.
So we're trying to interject stories here.
Oh. Wait, so in your audiobook, you besides reading directly, you add in commentary too?
Yeah, I think I got the idea from who was David Goggins. Have you ever read that book? But his audiobook has a lot of interjected stories, and to add a lot of things in there, which I thought was a cool idea.
Oh, please let us know how to get a copy when it does come out.
I will. get on my email list, get on Dean's email list. And then if you guys don't have any more questions, we'll wrap it up for this evening. And find us at raaloha.com. If not, I guess that we will cue the outro.
Free real estate investing group, check out reialoha.com.
We're just two local guys with so much to say. So listen to the Real Estate Braddahs today.